Good morning to Schneider Downs, our clients, friends of the firm, and those that are watching this market commentary video. We're taping this on Thursday, October the 12th. Before we get into the capital markets and recapping the third quarter, I want to first start out. It's hard not to talk about. It's hard to talk about capital markets and stocks and bonds in a time considering what's going on in Israel and the heinous attack perpetrated on the Israeli people by the terrorist group Hamas. Our thoughts and prayers are with the Israeli people, first and foremost, those that are grieving the loss of loved ones, and then as they go on their campaign to defend their country. So certainly starting off the quarterly commentary on a somewhat somber note, but certainly want to express our thoughts, prayers, and condolences to the Israeli people. So kind of moving on, my name is Jason Staley. For those that don't know, I'm the Chief Investment Officer and partner of the firm. And with me is my Manager of Research and Due Diligence, Mike Divens. Mike, good morning.
Good morning, Jason. How are you
doing? Doing well. Obviously wish we didn't have to start on that note, but certainly there's no shortage of things to talk about. But I think that as we sat down as an investment team to discuss what happened in the third quarter and take a view now that basically 3/4 of the year is kind of baked from a performance perspective, talk about kind of the two themes. And I think the two themes that we came up with were kind of somewhat in conflict with one another. And as you read through the note and as Mike and I go through our conversation, I think that the conflict between these two themes will be very noticeable. And that is interest rates continue to rise.
Yes.
And artificial intelligence is dominating equity markets. And then sometimes those two things are in conflict. So as that kind of as the backdrop, maybe kind of give a quick summary of what happened in the rate market, and then we'll talk about how that's kind of affected most of the equity markets except for mega cap technology stocks, which don't seem to be affected by interest rates or inflation.
No, I appreciate that intro, Jason. I think very plainly, it's no surprise. Interest rates have been rising now for 2.5 years. And obviously in 2022, markets reacted, we believe, appropriately. Interest rates going up, you can finally get some return on bonds from coupons, and equity, no need to take the added risk in the equity market. Well, in our early conversations in 2023 and even late 2022, it was, what do we think is going to happen? And I'm not sure if we thought that 7 stocks would dominate and pull the S&P up 36, 7, 8%, whatever it was at its highs when you look at those growth companies. So to that point with interest rates is what you saw in the third quarter was the belief that interest rates, they did go up. I mean, the 10-year almost hit 5%. Mm-hmm. And you see almost a kind of U in the yield curve now, where before it was just inverted. Right. And the thought when you see an inverted yield curve was recession's coming, right? It's not here today, but it's coming.
Right.
And then the thought is as it goes back, as it steepens or normalizes, that's normally recession is imminent. I think imminent's the right word, today, tomorrow, sooner.
Yeah, when yield curves uninvert, right? And by that, it's just, when Mike's talking about the U, kind of for a visual, if you looked at like the 3-month treasury, I think it's had a yield of like 5.4%. Mm-hmm. And then you had kind of the 10-year, which almost touched 5%. Mm-hmm. And really while the yield curve is still somewhat inverted, when we started the year, the 10-year treasury was at 3.8%. And then it just kind of ticked up. And then at the end of September, we almost hit 5%, which I know that 5.4% is still very much more than what you're seeing in the longer term treasury market. But as that U shape becomes more of a straight line, and then you get the uninverting of the yield curve. As Mike said, typically when you have an inverted yield curve and it becomes uninverted, that means that a recession is somewhat imminent. And I think from the standpoint of the fixed income market, the U.S. Federal Reserve and central banks globally, outside of Japan, they do some quirky things with yield curve control. So outside of Japan, they just do things a little differently over there. You can the most Federal Reserves and central banks control the short end of the curve. And we define the short end of the curve, let's just say 3 months to 2 years in terms of maturity. The U.S. Federal Reserve, by and large, kind of controls that part of the market. The longer end of the yield curve, that is more determined by the market and investors. And while we did get a 25 basis point increase in July, by and large, investors are taking a look at the macroeconomic backdrop. And this is obviously, this movement in yields was pre the invasion of Israel by Hamas and the attack that we started this video by. However, kind of before that, the 10-year hit almost 5% because we thought we were going to get a hotter than expected inflation number in September. That kind of came through. Yep. Oil, which we touch on in the letter, oil hit almost $95 a barrel, kind of 52-week high. So the investors are taking a look at the macroeconomic background and saying, like, you know what, Mr. Market, I'm demanding more compensation, right? I want more yield, and I think that for the first time, you've seen that push pull of, hey, you had this arbitrary, well, I could lock in the 10-year Treasury at 4.9% for 10 years on an annualized basis. Or I could take the 2-year Treasury yield and get 5.11%. And it's this trade-off of, do you lock in yields for the short term, or do you look longer out on the curve? And I think that's kind of a big discussion of ours, right?
It is. So when we're talking about longer end of the curve, what we're really talking about from an investment standpoint is longer term bonds, right? What can we invest in? The intermediate out to the longer term, if you've listened to this or read the commentary that Jason puts out, we've consistently, I think, been very good in saying we believe in lengthening the duration, which is just the years out of the bonds, basically, in your portfolios. Right. And I think we've been very consistent in that from the start. And while yields have continued to go up this year, which wasn't unsurprising, and there may still be one more rate hike, we believe that, to Jason's point earlier, your risk premium to go and get equities now is very, very high, because you can get 5-6% in these yielding bond funds, ETFs, treasuries, CDs, all these other areas. And so while we, no one's in favor of the Fed destroying what 2023 has brought so far, we do need them to do what's right. And whether or not they hike or not, we do believe that they need to do what's right for the economy in the longer term. Right. And so, like I said, so whether or not they rate hike again in November, and there are differing opinions now. I know people that were doves now might not be, and where hawks are saying maybe we should stop. We had 2 numbers come out yesterday and today. You could argue a little higher than thought, so there is probably more thought of rate hikes. But I think in the longer term, we feel really good about being on the longer end of bonds, where the argument to that is, well, why not just take that 6-month Treasury or this 9-month CD at 5.5 or 5.6, and just, to Jason's point earlier, we were talking was, bury your head in the sand, don't worry about it. Not a bad strategy. However, we do believe that you might miss out, or you might have some reinvestment risk if, gosh forbid, anything else happens that causes yields to drive down, and you're going to miss out on some areas that we believe is really good in the longer term end of the bond market. And we're not wavering on that, no matter what happens, I think, later in the year.
Yeah, I think, and I think it just kind of comes down to, when you think about those short-term treasuries and money market funds and CDs, like, you're going to lock in that yield, but in a risk-off scenario where you have, I think the term I use is exogenous events in here. And in exogenous events, it's Hamas coming out and saying, we've been planning this attack for 2 years. It's Russia finally invading the Ukraine. It could be China, escalating in Taiwan. There could be there's a plethora of geopolitical hotspots, or just we haven't even talked about kind of the financial impact of commercial real estate and the debt on balance sheets and things like that. There are these exogenous events that you cannot predict, And in those cases, those those short-term treasury bills are going to be fine. The money market funds aren't going to move. The bank certificate deposits, as long as you're under $250,000 of exposure, making compliance very happy right now.
Yeah, right.
There's a lot of things, but assuming you're under all of the FDIC coverages, those bank CDs are going to be fine.
Yep.
But they're not going to appreciate in value. And I think when we construct portfolios, if in a risk-off scenario, and take 2022, that's its own set of animals. That was a great yield reset after a decade of artificially low interest rates. But if you take 2022 out of the equation, your intermediate term bonds, right? And we're never going to go out and buy the 20-year or 30-year treasury. It's just way too much price volatility, and just go ask those investors about that Austrian 100-year bond with like the 2% coupon on it, how they're feeling now. They're they're down like 66% or something on the bond. Way too much volatility for us to take kind of long-term risk. But in the intermediate part of the curve, you're seeing the best yields we've seen in 15 to 20 years. From a valuation standpoint, if you're just looking at it, investment grade fixed income look substantially more attractive than stocks, right? Yes. The equity risk premium in stocks, again, in part because of the 7 stocks we're going to talk about, you could the earnings yield on the S&P 500 isn't terribly better than the 6-month or the 3-month Treasury bill. And I think that when you look at the fixed income, and the reason that we continue to be very much in favor of adding to core fixed income, is you're locking in these yields for, let's just say, kind of on the municipal side, the average interest rate sensitivity or maturity kind of. The average effective duration is somewhere kind of in the 5.5 to 6 year range. Same thing on the taxable, maybe a little bit more. But you're locking that in for a significantly greater amount of time than these short-term treasury bills. And then on top of it, and what we really like from a construction standpoint is if risk does fly off the table, bonds have this proverbial seesaw where prices go up and yields go down. It's not to say that we don't have any exposure to shorter duration bonds. We do for our client cash needs. We have been buying treasuries, right? We've been able to buy treasuries, buy money market funds where appropriate. But for longer term, the more strategic asset allocation for our clients, so this is an opportunity that comes around on the core fixed income side, every 15 to 20 years. Absolutely. And so that's what we're doing. That's what we're doing in client portfolios. And I know it doesn't bring a lot of comfort to our clients, but had a similar interest rate move. The similar interest rate move played out early last year. Bonds were down 8, 9, 10, 11%. Now, municipals are flat to down 1%.
Yes. Just
goes to show you that yields have reset higher. They're blunting a lot of that volatility. And if we're willing to just take a look into the shorter term, the short intermediate term, like let's just say 2 to 3 years out, I think there's a world where we certainly expect interest rates to be lower, and our core fixed income yields that we locked in 2023 to be much better, to even be that much more attractive, right? Locking that in now versus trying to go, transitioning now to what's playing out in equity markets. And in the third quarter, there were two things. There were two of the broad asset classes were positive in the third quarter. The Bloomberg commodity index, driven almost entirely by the rise in energy price. When oil goes from like the low 70s to the mid 90s, it's going to be a good quarter for the good quarter for the commodity index, which is still negative, right? Negative year to date. And then the 3-month U.S. Treasury note, as yields go up, you don't have any interest rate sensitivity. That would make sense that you did well. Everything else was negative. The S&P was down, 3.25. Small caps were down 5%. International was down 4. EM was down 3. Real estate investment trusts, so publicly listed real estate, down almost 7.5%. And then you kind of had the fixed income, so taxable, the U.S. aggregate index, so kind of treasuries and agencies down 4%, and then, down 3.25%. And then municipal bonds down 4%. There's probably some seasonality into that. But taking a step back and looking at where performance is, so we've got higher interest rates putting pressure on bonds. The short end of the curve looks very attractive. However, kind of zooming out, we kind of like the core exposure. the only part of the equity market that has not been affected by rates, because whether you're talking about small caps, mid caps, emerging market stocks, which have questions about dollar and funding exposure with especially with the level of U.S. interest rates. The S&P 500 is up 13%. Mm-hmm. International developed stocks up 7%. So I think we've been to recap. We've liked international developed stocks. We still think that they're undervalued. They've done a very good job in the portfolio. Second best performing broad asset class behind, you guessed it, the S&P 500. But really, Mike, it's really not the S&P 500. It's more like the S&P 7.
Right.
And in particular, people have been calling it the Magnificent 7. So maybe talk a little bit about artificial intelligence and why that may or may not, at least for now, seems to be impervious to the pressures of interest rates and inflation. Yeah.
So to Jason's point, it's really been 7 stocks, and you could argue maybe throw a couple industrials in or something else in there, but it's really been these 7 stocks that we're able to grab the AI headlines. Let's just say it what it is, right? You have one that makes all the chips that everyone wants, and then the other 6 that everyone thinks can capitalize on. That they can buy the chips and somehow still be profitable, and then be able to charge whatever the heck they want. Really, right. Is really how that AI play works.
So NVIDIA is the chip maker. And then the other 7 stocks. When we say Magnificent 7, it's important to remind people that there's really 6. But Google has 2 share classes. Class A, which has voting rights, put in quotes, and Class B. So really the top 7 stocks, it's Apple, it's Amazon, it's Google, so Google Class A, Google Class B, it's Tesla, it's Facebook, or now called Meta, but no one, it's like Heinz Field, right? Yes, it has a new name, but no one's ever going to call it Acrisure Stadium. Everybody calls it Heinz Field. No one's ever going to call Facebook Meta.
Yeah, right.
That's the 7. And then, you got Tesla in there too. So those are the 7 stocks, but then so the NVIDIA makes the chips, and then the other 6 kind of capitalize on it. Maybe talk about their valuations and the price movement there.
Yeah, so these stocks are up anywhere from 30 to, I don't even want to try to guess what NVIDIA is up today.
Like 100.
100, let's just say 30% to 100%. And then you have some others that are kind of on the outskirts that have kind of, we're just like NVIDIA. You have your AMDs of the world. You have other things that are kind of, they've come along for the ride, whether they are deserve it or not. And to Jason's point, while we say it's 7, you could argue it's 10, it's 15, but it's this driver of AI. And we're not saying AI is a bad thing at all. It'll somewhat, hopefully be somewhat regulated, so we don't have like a Terminator thing coming at us or anything like that. But it really is something that can really drive the economy to be that next thing, right? You've had these periods, right? Hopefully not at 2000.com where you have made up companies. But one of the things that these 7 companies do have in common, and we can include Tesla now that it's in the S&P, is it's profitable. Right. One of the things that has really driven home this year, and it's something we'll get to later in mid and small caps, is companies that have positive cash flow and that are profitable. One, they can afford these AI chips, going back to the AI. But the other thing too is kind of going back to the first part of the conversation is, a reason that tech stocks and biotechs and small and mid caps don't do so well when the rates are rising is they have to borrow. And now it's more expensive to borrow than it has been in 15 years.
Sure.
And so you've had this kind of tech boom since, you could say 2016, but I'll even go back to 2012, 2013, when it's basically been free to borrow. Well, the reason these 7 stocks may act differently along with the AI and everything else is they don't have to borrow as much. They have large cash flows. Apple could buy many companies in the S&P, just using them as the example. They haven't, so they've returned some cash to shareholders, but I think it's thought that they're going to use that cash at some point. And it may be to blunt some of this interest rate thing. But I think, twofold on AI. One, if done right, it very well could be really, really great. The problem is it's, even for these companies outside NVIDIA, it's a cost center. And it's a major cost center. If these chips are going for $40,000 on eBay or whatever the latest number is, imagine what Microsoft's paying for these things. And they're not buying one. They're buying as many as they can get their hands on.
Right.
As much as NVIDIA can design it. Now, they're not building it, so that's another issue, right? They can design as good a chip as possible, but whether it's Taiwan Semi or these other things that build these chips, we need to make sure that these companies can get them, and at some point, they got to know how to use them.
Yeah.
And I think that's the key when we look past what's happened so far with these companies.
Yeah, I
right?
think that's the big thing, and I think that you're coming off like these stocks were hammered in 2022, and
yes.
it's important to note that most of these, like a lot of these companies, if you were to do a price chart from January 1st of 2022 through 9/30, I think 2 or 3 of them are back to like even.
Yes.
The rest of them are still kind of in a drawdown. Just to give you an idea of how much they declined in 2022. So there's a volatility aspect of it as well. But I think that to your point, I think it's going to come into focus as like the easy earning comps are over, right?
Yes.
The expectations were very low. They're going to continue to get higher, both in the aggregate on the future, and then based off of the comps from as they get into. So we wrap up the third quarter, get into the fourth quarter, the first quarter, when you're comparing against 2023 results, which were very, very good, right? So coming off of kind of beating those low expectations. And then I just think investors are going to look and they're going to start to demand to see increased profitability and margins. So you're saying you're going to capture this AI, and we're not here to be skeptical of the technology. Like, first and foremost, so much of it is over my head. I mean, this guy went to Carnegie Mellon, so it might not, it's a little bit less over his head. But for this Mercyhurst University grad, go Lakers, by the way, it's a little bit over my head. And by a little bit, I mean a lot. We're not here to question the technology, but what we're here to say is at a certain point, and we use Tesla as an example, at a certain point, you have to be able to show that you're profitable.
Absolutely.
And Tesla has, to varying degrees, been able to show that they're profitable. And they've been rewarded, right? In terms of, and you look at what's going on right now with the union and the labor strikes. Everybody realizes kind of the cost to make a Tesla is significantly less than the cost to make the GM or the Ford electric versions of those cars. I think that we're going to have to start to see kind of some of that kind of come through in terms of seeing it flow through the income statement. Start to say, hey, here's our improved margins.
Absolutely.
And I think that's I think in the U.S. on the U.S. side of things, you're really driven by the fact that this promise of AI can blunt the interest rates and inflation and maybe a slowing economy. We're not here to predict recessions. Although I do think that like economists are like kind of like weather forecasters. You kind of just got to be like 30%. It's like hitting 300 to get you into the Hall of Fame.
Absolutely,
in baseball. Right? I kind of think that's kind of like it'd be a good job, right? So I think kind of transitioning to like the others, right? So there's like in the equity markets, it's been U.S. equities up 13%, international developed up 7%.
Absolutely.
International developed still looks very attractive. We've talked a lot about it, but I think on the U.S. side, you're starting to be able to see small cap and mid cap stocks trading at 12 times earnings forward on the forward side. And that has historically been a very good time to buy them. They are more affected by interest rates, right? They're just to Mike's point, I think it's an important one. The way that your small cap or mid cap company funds itself is a lot different than Microsoft. Microsoft has basically an unlimited access to the corporate debt market.
Everyone's willing to buy a Microsoft bond.
Everybody's willing to buy a Microsoft bond. We'll just take a public company that's based in I don't know, Pittsburgh, Cleveland, Cincinnati, Columbus. That's let's say $2 billion market cap. They're bank loans, right? They have revolving lines of credit, and those are resetting higher and higher with inflation. So what we're not saying is that the performance of small caps, while we think is somewhat oversold, you can understand why they come under a little bit more pressure as interest rates rise. But looking forward, buying them at these multiples looks incredibly attractive.
Absolutely.
And I think there's a difference too between small caps and mid caps and publicly traded real estate, which publicly traded real estate, there's some things that they're working out there, but the most interest rate sensitive, right? When you pull down 7.5% in a quarter, like publicly listed real estate did, and the Russell 2000 trades down 5%, it shows the level of interest rate sensitivity. But if you do believe that interest rates are we're in the 8th or 9th inning of them being raised, then you have to start to think, well, what's our next play? And so we kind of like some things that maybe aren't on CNBC and Bloomberg as much.
Yeah, it's kind of the same point we had with investing in intermediate term bonds when we did, right? It was, hey, we might be a little early, or we might be in the, to Jason's point, 8th or 9th inning, but we want to be on the front end of this.
Sure.
And to Jason's point, with small caps being at a 12 valuation, right, which, is very low. Let's just say that every time it kind of hits this level, once again, this one, we don't want to be prediction or prognosticating.
It tends to bounce over the medium to longer term.
Longer term, right? So we're at these levels. It's one of the reasons why we stress diversification all the time. Whenever we talk to you guys as clients, and when we're meeting with you all the time, is we can't tell what's going to happen tomorrow down the road. All we can do is put the portfolio in the best position possible. And if we believe in small and mid, and we do, then there is really no better time to have them in the portfolio. I think is the simplest way to say it. Once again, not saying that we're all in, we're doing anything different.
No.
But this is why we are diversified, and we do believe that over time, this will work itself out where rates will come down and these companies will be able to be better valued because they can get back into the debt market. They don't have to be as leveraged. Mm-hmm. And so someone who's earning 5-6% in the fixed income market doesn't have to reach for that same risk premium in the small cap market, mm-hmm. where if bonds at some point slowly start to go down in yield, then there's less risk to go into that small mid cap space.
Yeah, and I think too, we talk a lot about kind of like the next incremental dollar of risk assets, and it's, for a lot of our clients, the S&P 500 or U.S. large cap has been the largest position in our client portfolios, rightfully so. We're not saying that we're going to be dramatically cutting that in half, but when we talk about the next incremental dollar in, I think what we're saying is that non-U.S. international developed, mid cap, small cap, and then within fixed income, understanding that some of these intermediate term bonds are flat, maybe modestly down, but when we look forward, right, and I think that there's the world you're living in now, and then what you're investing in. We always talk about investing being a journey, right? And no one year mm-hmm. truly affects it one way or the other, right? You can't let it affect it, rather. And I think that when we look at the way that we're going to earn returns, the contribution of returns, it's not going to surprise us if small caps, mid caps, international stocks lead us from an attribution standpoint over the next 3, 5, 7 years. Given how concentrated the U.S. equity market is, given where it's valued relative to other parts of the market, and then on the fixed income side, we're going to be able to make more money off of bonds than we have in 15 to 20 years, and that's going to be how your portfolio moves forward, how you earn the overall rate of return. That we expect that it's going to be a little bit different than the S&P 500 of the last 11, 12 years, and as it relates, we'll just pick Google. You could have bought Google, Alphabet in 2011 for 9 times earnings. Yeah. Now it trades at a substantial premium to 9 times earnings. So there's a reason that the S&P rallied the way that it did, but also kind of the factors that affected the free money, the low interest rates. I think the one consistent thing we've seen out of this Federal Reserve is they have said, we're not going back to that. Yes. We're not going back to ZIRP, zero interest rate policy. We've seen what that can do. So it's going to be some combination of higher for longer and probably, a little bit more inflation than that 2% target. So certainly a lot to digest. I think we want to end it with this comment, which is, first, if you're feeling uneasy about your portfolio, it's not unwarranted. We live in really interesting times in terms of what's going on in the world geopolitically, what's going on with interest rates. If you're uneasy about what's going on in your portfolio, please reach out to your Schneider Downs advisor. We'd love to have a conversation with you. And then on the flip side of that, we're going to be reaching out to you, check in, make sure everything's okay, set up those quarterly meetings, and hopefully, use this video, the quarterly letter, as a way to walk through the portfolio so that you're able to know kind of the 3 things that make up the foundation. Do you know what you own, why you own it, and how it fits into your portfolio and your financial plan? So that's all we have for you today. Mike, thanks for joining us.
Thank
and then
you, Jason.
Again, last but certainly not least, again, we're going to end it the way that we started with our thoughts and prayers go out to the Israeli people. So thank you again, and we'll see you again in 3 months.